So, good afternoon, everybody. Can you all hear me? No. Okay. 1, 2, 3, 1, 2, 3. 1, 2, 3, 1, 2, 3. Ah, that's better. Yeah, very good. Okay. Good. Okay. Good afternoon, everybody. My name is SeanKlein. I'm going to take us through the next 40 minutes or so of this discussion. Thanks very much for coming downstairs. What the others don't realize is that we've got a much more comfortable environment down here. So actually, I hope you're not just here for the environment, but if you are, you're more than welcome as well. So this particular panel session, there are two running together, as you know, right now, is called Delivering the Reforms Needed to Strengthen the Economic and Monetary Union. And Business Europe has been writing on this and producing various documents about this very issue. And what we would like to look at this afternoon together is basically around the themes of how to ensure the good functioning of EMU. And so we'll look at whether or not we think it's functioning properly at the moment. How to combine national and European level reforms so that we can both strengthen EMU and create more growth. And also how to strengthen the Euro's international role, and its standing and status. Some may say that's been growing, but more needs to be done. I have a great panel with me here up on the platform, and I'll introduce them to you. I think you may have some details on screens if you can see them. At the far end there is Klaus Deutsch, who's the president of Business Europe Economic and Financial Affairs Committee. He's also the Director for Research, Industry and Economic Policy at the Federation of German Industries, the BDI. That's correct, isn't it? So you're very welcome, Klaus. Next to him is Danny McCoy, who is the CEO of Ibec, which is the Irish business organization. Very good to see you, Danny. José Leandro, next to him, is the director at the Directorate for Economic and Financial Affairs at the European Commission. Thank you for being with us. And last but by no means least, Boris Kisselevsky, who is the head of the ECB representation here in Brussels. So we have absolutely the right people to discuss this issue and talk us through how we can make things better. And as is the usual fashion, I'm assuming that a lot of you are perhaps down here because you have some connection with this issue and certainly some input, and we'd definitely like some of that as well. So please, at given moments, feel free very much to participate when the moment comes. So we formulated a sort of question to get things kicked off, and I wonder whether the scenario that we're living through at the moment in the world has some impact on this, and perhaps you'll all tell us whether it does or not. But the initial question was, is Europe ready for the next crisis? And of course, what we were thinking of was, I guess, 10 years ago and that time since then. I wonder to what extent actually some of that might be being put to the test, perhaps not straight away at the moment, but there may be some knock-on effect possibly of what's going on. Maybe you all have some thoughts on that. But that wasn't the initial thought. It was more, we had a crisis 10 years ago that we've kind of been working through probably ever since. But is Europe and EMU ready for another one, should we be so struck? Klaus, if I could begin with you. You've got your Madonna, so you're fine.
Well, yes and no. I think we are clearly able to cope with a economic downturn that might come along with Corona by the usual use of fiscal and monetary policy tools and stopgap measures that would transition us through a period of several months in which economic activity would be severely disturbed by on the supply side, but also on the demand side. I think we can cope with that if it doesn't transit into a much larger economic and financial disturbance that would emerge either from the outside by a major breakdown of growth in China or in the US, or from international disturbances by a breakdown of global trade due to measures taken by governments largely to contain global health risks. I think the question you asked, would we be ready for coping with a much stronger economic and financial crisis as the one we had 10 years ago? Probably not fully yet. We made some improvements on the institutional side, and clearly we have better institutions in place for risk management and for coping with a crisis, but we have not taken all the steps we need for preparing ourselves and preventing a new crisis well. And so there's still outstanding work that Mr. Gentiloni has in his homework been written down. But clearly, if you look at it, not the full scope of reforms that in the last Commission were entertained to be necessary are still in play. And I think that's a deficit we have to cope with. I think we need to be more ambitious on these topics as well, and not only pay attention to the more structural themes of the environment and digital.
Danny, do you think this needs sorting out urgently? I mean, do you agree that we're not, the system is not robust enough perhaps to cope with another 2008? And how urgent is it to get this sorted out?
Well, it's a bit like generals fighting the last war, isn't it? You know, that we think back. I guess the bit that's missing for me, having been quite deeply involved in the fiscal rules in a previous career, I even find it difficult to follow it. You know, that I think I've got a good knowledge, but it's got very complicated. And what's really missing, I suppose, is coordination, which again, I was struck by the Commissioner there in the last segment talking about the coronavirus has really brought across coordination. You know, some of the damage we'll see to our business models will be, again, inconsistent patterns even within economies. And so the coordination, I think, is really important. Something might come back to later on is that when we designed the fiscal rules going back to 1997, we were then in a kind of a panic mode, I suppose, during the financial crisis with 6 pacts and 2 pacts. But I suppose the bit that's interesting about how the world has changed in the last 10 years is the fact that we have intangible assets being the dominant driver. And intangibility has a lot of different characteristics than tangible assets. So you see the emergence of the technological giants who have, you know, it's monopolistic in structure, but actually it's more fundamental in a kind of a public good kind of nature. There's no production costs to the additional unit, etc. And I know in the monetary policy, particularly Jonathan Haskell, who's on the Monetary Policy Committee for the Bank of England, is now talking about in a world of where intangible assets are on balance sheets, how do you lend to those? And then what has consequence that have for the long-term real interest rate in the economy? I believe that intangibility probably has lessons to learn. We've lessons to learn about this intangibility for our fiscal rules as well, in that the world has changed. I don't know the answer to that. It's more posing a kind of a line of thought. But if intangibility is the big driver of balance sheets as it is, then does that have consequences for the type of fiscal rules? So one other aspect. Is it the case that GDP, which is the underbidding of the fiscal rules, proportionate, be it debt or deficit, is GDP actually connecting in terms of the right measure? I'm not talking about its accuracy, I'm talking about its signaling. So in other words, if you see, as a case in my country, we've seen our GDP increase by 100% in 6 years, right? So it's an exceptional story, but it's a story that's embedded in those intangible asset story. Can you be sure that the life experience of the household is perfectly correlated to that 100% increase? And what does that mean for the fiscal stance? These are just kind of some questions to be posed. But I think it's more pervasive than even just a small blip that is the Irish economy.
José, from your point of view, are we ready for the next crisis? Is the system ready for the next crisis?
Okay.
You come from the Commission.
Right.
Is this something you look at, I presume? What's your thoughts on that?
Okay, let me take a step back, because a lot depends on what you mean by the next crisis. So, before this coronavirus issue came up, we had already forecast a protracted period of low growth. That was already the baseline. When we came up with our winter forecast, it was basically flat growth over the period 20 and 21. 1.2% per year, flat. We had not, in our central scenario, included any recession. That was not in the cards. This was mainly driven, this flat growth was mainly driven by a combination of factors. There was higher uncertainty, there was much less supportive external environment because of the protectionism tensions. There were structural shifts taking place that affected mainly the manufacturing sector. All these things were playing and pushing us into this period of flat growth. Now comes the shock of the coronavirus, which we had identified in our forecast as a downside risk. And we had said that it's a significant downside risk. Some of these risks are now materializing. We still have to see how exactly and how much this will affect the growth in the short run. But beyond these short-term factors that are keeping us in this low growth, there are also long-term forces that are at play. Aging, low productivity growth. All this, the combination of these two things, could mean that we could get stuck in a very long period of low growth, low inflation, rising inequality. That is already the underlying thing behind this discussion about this shock of the coronavirus now. I think this is important to understand. And when you project long-term growth to 2029, what we see is potential growth going down from what it is currently, 1.2, to below 1% in 2029. Basically driven by aging that is now kicking in big time, and labor force coming down, and capital stock staying low. That is what is at play. Now, staying stuck in this low growth, low inflation, rising inequality is not a fatality. It depends on how we react to this. And for me, this is already a crisis. Aside of the coronavirus or any other shock, this is a crisis, right? But it's not a fatality to stay stuck in this long-term growth. It depends on how we react to it. So, in the short run, we need to address the issue of the coronavirus and these short-term factors that are pushing us to a lower growth. The Commissioner mentioned what is going on in terms of discussions at the European level, at the global level, to see how best to respond to this shock. He emphasized in particular, and we can go into more detail on that later on, he emphasized that already in our fiscal rules, there are ways of accommodating some of these shocks. So that's for the short term. The longer term, we need to push investment. There is a need, as I said, to increase the capital stock and increase productivity. So you need structural reforms, you need regulatory reforms, and you need investment to push potential growth up over the long run, right?
Okay, yes, sorry.
Now, this is, I think, important to understand then what we're talking about when we talk about EMU and the completion of EMU. Because the incompleteness of the EMU is one of the factors that is also contributing to this lower growth. The fact that we don't have a full capital market union in place, right, means that we're not able to mobilize the capital and reap all the benefits and the potential benefits of a fully integrated bond market, equity market, and giving the firms the access to this capital. Also, in view of these digital and green transitions. So that's the first priority in completing EMU, is capital markets union and the banking union.
Okay, we're going to come back to both of those, I think, in a moment. I'm just curious, and this is a cheeky question from me, in the forecasting that you've been looking at, and you say you've taken into account some of the known knowns, as it were. Has that forecasting not included another potential crisis of the magnitude of 2008?
What do you mean
when you've been doing the forecasting? Just a curious question.
No, when we do the forecasting, then we assess the risks to these central scenarios. So you have a central scenario, and then you assess potential risk to this scenario. That could be upward risks that brings growth up, or downside risks that bring growth down. We had identified already the coronavirus a few weeks ago when we came out with our winter forecast that this was a significant downside risk.
Okay. Boris, from the central bank's point of view, are you happy that EMU is doing all it needs to do, or is it ready for a potential another crisis? I mean, we could talk about Corona as well, but maybe something more significant, even more significant as well, perhaps.
Yes, complementing what José just said on the European side, I mean, we are now 12 years after Lehman, so a lot has been done, a lot of positive things have been done, but for sure we are at an unfinished agenda. So it's still, we are not there where we would like to be in terms of EMU deepening. So as José said, there's the issue of the capital markets union, which will be the important element this year, also in the context of Brexit, of course. So this is a topic which is key for us as central bankers. In addition to that, there is a banking union. True, we will come back to it. There is a loss of pace in the reform schedule, which is kind of worrying in the last month, but we still believe it is important to have this famous third pillar of banking union. In addition to supervision resolution, we should have the deposit insurance. And here we have a window. We have a window of this new institutional cycle. So I believe it would be really important to make progress within this institutional cycle, within the 5 years that are now opening, and where all institutions are aligned on that. And in addition to that, this was mentioned by Danny also, it's the issue of fiscal rules. So here we are in beginning of a reform. We as ECB, we think that this reform is absolutely needed. We need more clear fiscal rules. We need more less procyclical fiscal rules also, as the Commissioner said. So this is something on which we would also like to put the emphasis, but it's important now to start delivering and to use this momentum we have from this new window.
Klaus, sort of talking about the Commission reviewing economic governance of economic monetary union, how wide-ranging does that need to be? What about the Growth and Stability Pact? Is that flexible enough? Is it being observed enough? Some thoughts on those?
Well, it's part of the picture, and I think we have to make sure that the governments and parliaments who have to apply the rule book understand what is in there, and that there's a stronger focus on sustaining economic growth and lifting productivity and investment within the rule book without jeopardizing fiscal sustainability going forward. Now, maybe José didn't say at the beginning that, of course, the euro area has made great progress in deleveraging the public sector. If you look back, this was a 10-year exercise of bringing public deficits under control, and I think, by and large, they are under control again. But at the cost often of having too low public and private investment support. And I think that led us into a situation where we have skill shortages, we don't have enough spending on education, we don't have enough spending on infrastructure, and we have sometimes public budgets are too focused on consumption and too little on investment. I think in that whole framework, member states have to do a lot. The fiscal framework is just a rule book. I think much more important is what they do about the European semester process. And without going too far into publications, we will only get to the media in the course of the next weeks. I think you see a constant drop in reform activity over the last 4 years, both at the OECD level as well as the European level, and this is not sustainable. We can't afford to do nothing. And I think it's much more important to get growth going, and if you think about the connection to the environmental and digital fields, we are speaking about 250 to 300 billion euros of additional investments. It's roughly 10 to 15% above current levels of private and public investment in Europe. If you want to get this going, we need incentive schemes for private investment, and we need additional public investment for greening, transportation, the grid system, and all the rest of it. I think we have to put these very different angles together at the level of the heads of states, because if you leave it to the ECOFIN, they don't know how to cope with that, because it's too much environment. If you leave it with the climate people, they don't know how to do the fiscal stuff. And I think so I'm much worried about, not so much about the Commission, who has processes of working together, but about the governance both in the Council and in the Parliament, because there it's usually sector policies, and they don't work together. But this is what we need to do. Now, I think the review is an important part. I share the ambition of Gentiloni. I think these are the right points. It's very difficult to do that in practice. We need a little bit more clarity on investment rules and a little bit more flexibility there, but we can't jeopardize fiscal sustainability in a low growth, low inflation, no reform environment. This is a touchy issue. If we don't move on growth, we won't make progress on fiscal sustainability either.
Danny, there's a lot to grapple with there, certainly in those comments about the governance of how the system is working. And you seem to be suggesting that in the Irish case is a case study, I suppose, and maybe that's an example of where some of that hasn't worked properly to keep things under control so much. Would that be fair? And what needs to be done?
I do think the Irish case is sui generis. I don't think it's replicable, but there is...
Unfortunately, if you could turn everybody into an Ireland, we would be...
I do think there are lessons, though, in its magnitude that can reveal some of the tensions. And Klaus is right. I mean, it is not technically true what I'm going to say here, but if I had the world described to me now, 15 years ago, it feels like monetary financing, something that was precluded. It's not technically monetary financing, but it's the fact that we live in such bizarre monetary conditions that has allowed, normally we would have seen inflation erode some of those high debt levels, but actually it's quite a lot of cash has ended up, and even the taxpayers have quite a lot of cash to make their payments, etc. across. So it's a bit of a bizarre monetary arrangement that we've gone through the last 10 years. And when you couple that with this intangibility, which I really think is a significant story, the rules just don't feel to me as if they're designed for the world that we're operating in now than the past. And I just can't quite explain it. I just know it as a proposition that it feels like there's something missing.
So I can't let you say something like that without, have you got some thoughts on how, what specific rules do you think need to be amended and in which way?
Well, for instance, if you take the same logic that I think one of the contributors from the floor said, when Europe talks about its emissions going down, well, actually, we know the emissions in the world haven't gone down. There's just been a shifting of the production, yet we still consume, really are consuming those emissions. So have we accurately measured that? In the context we're now talking about, we're defining fiscal as just the government's balance sheets and the government's sets of accounts. Yet we know the citizens are the state. This is just one arm of the entire balance sheet. How much are these rules actually interplaying with the households and the private sector, be that firms' balance sheets or households' balance sheets? And if they've changed dramatically, which I'm arguing they have, particularly the corporate one being driven by intangible assets, perhaps we're seeing the same thing occurring in the households as well, as to what type of assets households have. I can't remember, somebody was on about the washing machine earlier on. Households may in the future have very little assets. It'll all be done by the purchase of services. Does that have a consequence for fiscal policy? My gut tells me it does, actually. But we've defined quite narrowly from our textbooks what is the government, what is a central bank. And yet we know, in the case of central banking, there's a whole plethora of alternative ways to finance the world right now in different ways. So it just seems to me the fiscal rules feel very dated to a very different type of economy, but I can't put my finger on what the solution is here.
You segue nicely into a question for Boris here about, as a central banker, do those rules feel out of date and in need of updating, and are they working for the way that we need to invest at the moment? As we know, the strategies from this week, from last week, for next week, are going to cost an awful lot of money. A lot of investment needs to be there. Are those rules up to scratch?
Indeed, they're quite static, but before that, there are two levels. I would say there's a national level and a European level. On the national level, I agree with Klaus that there is the issue of lack of implementation of national reform. The CSRs, the European semester, could work better, let's say, in that sense, and there's not enough ownership of reforms by national governments. And in that sense, for instance, just to give a very concrete idea, to have a national sort of a fiscal board that is independent, that is advising the government in an independent way would be already some progress. And you see, indeed, in Europe, you see two types of countries. You see the countries that have room, that are not easing, and the countries that believe that they have room, and they are easing, but actually they don't have room. So when you accumulate this, you have a quite neutral fiscal stance, which is quite good, but when you look deeply inside between the countries, they are very different elements. And this is what the fiscal, and now I come to your European level, the fiscal rules were not able to avoid this procyclicality. They were not able to really avoid politicization also of the rules. They're also extremely complicated. And so this is something, I agree, it's extremely difficult to change, because there are so many ideas, and it's very easy to say to find simple rules, but it's something we should at least aim at, and this is something the ECB would also encourage very much, and happy if the Commission is looking into simplifying all of this.
So I wanted to sort of move on to the European semester and national governments implementing the proposed structural reforms. That isn't happening in the way that it should, as far as we can see. What more needs to be done? What can the Commission do? What would the Commission like to see member states actually doing? I mean, obviously, other than implementing all the rules, what incentives do they need to do this? Because this presumably is one of the reforms that needs to be looked at, isn't it?
Well, you know, reforms are complicated, and you might remember what ex-President Juncker said. We know what reforms we need to do, but we don't know how to win elections when we do them, right? So that's the whole political economy about reforms. So I think we should not be overly negative about the reforms that have taken place. If you compare to 10 years ago, the way labor markets work, for example, today in the euro area, much more efficient than it was 10 years ago. The segmentation, the rigidities in the labor market have, to a large extent, been addressed. So now we would like this to continue. There is a lot to be done on the structural side to push productivity up, as I said before, because that's one of the things that's keeping us in this long-term growth, low growth. Productivity up. A lot of these reforms don't cost money. Improving the business environment actually doesn't cost money. It costs maybe some political votes here and there, but they don't cost money. So, but it's very difficult to do this where you have a construction where monetary policy is centralized, fiscal policy is decentralized. We don't have a fiscal capacity at the central level. We are the only monetary union without a fiscal capacity at the central level. And where sectoral policies, structural policies, are also decentralized, where the EU has no powers. But okay, it's complicated, but we are making progress, and the euro area is in a much better place today than it was 10 years ago. Now, I think, as I said before, it's not enough, because the challenges we are facing in the longer run require probably a rethink of the rules themselves, which, as Danny was saying, and Klaus and Boris, probably they were designed for another world. We are now in a world of very low interest rates that have been declining on a secular basis for decades and are now extremely low and probably will stay very low for a long time. At the same time, as I said, you have potential growth going down because of these long-term forces, aging, productivity, etc. In a context like that, there is a debate about the role that fiscal policy should play to bring potential growth up. Not just stabilizing the economy when there are shocks, but bringing potential growth up. Also, in view of these transitions that we have to do, green and digital. So there's a whole debate about that, and the changes to the rules have to be approached with this new paradigm in mind. So we have launched a review of the fiscal rules that actually highlight all these points that I just made. And we opened a debate on this. You are all invited to participate. There's a website there. You can go there, share your views, and say what you think. We will take account of that. And after the summer, and the second half of the year, the Commission will decide how to go about this.
I'm going to open it up to the floor because we haven't got a huge amount of time. Has anybody got any burning questions? You've got the experts here who've started to cover some of this debate, this discussion. And you've just heard José talking about the website being opened as well, so certainly you'll be able to have a look at that. But anybody, any questions at the moment? Yes, there's one at the back there.
Simple question concerning the long-term economic models used by the...
I don't think we can hear you so well, actually. Is the microphone on? Can everybody hear? Just if you just speak into it and let the technicians will sort it out.
The question, if it's... Well,
Yeah.
the question is concerning the long-standing or long-term economic models used by the Commission. As far as I know, this is the first one is Primes, which is commissioned to Athens Technical University. Most of the national energy and climate plans are based on Primes model.
We're going to have to be really quick. We're going to have to be very quick, actually, because we've got very little time.
Sure.
Yeah.
The second one is the second, let's say, source is the aging report. I know. So the simple question are: what are the models used by the Commission? Long-term economic models officially recognized and used by the Commission. The first question. Second one.
We haven't got time. Sorry.
Prospects. Very short one. The prospects of Bulgaria and Croatia to join eurozone. How you could react on this?
Do you want to tackle that, José, whilst we collect another one?
Well, on the prospects of Croatia and Bulgaria joining the eurozone, there is a process going on. There are a number of commitments that have been agreed and need to be delivered. This is being done. We are quite hopeful that this will happen in the short run. But of course, it depends on the progress on this. As regards the models, well, we use standard models that are the same as ECB, IMF, OECD when we project, when we do these projections of long-term growth. We use standard orthodox, new Keynesian models, as they are called, when doing this.
Maybe just one
Yes.
tiny element on this Bulgaria-Croatia, just to remind that in addition to joining the euro, it was a decision to have them enter in parallel to the so-called single supervision. So the Bulgarian-Croatian bank would be subject to single European supervision by the ECB. So it's called close cooperation. And this is a parallel track, and you cannot do the one without the other one. So there's also the whole work stream on banking, recapitalization, and on banks before joining this single supervision in addition to
Absolutely.
So
Absolutely.
we work together with the Commission on both streams.
These are no conditions.
Our enemy is time always, and I just wonder if I could. We're going to have to go. We're going to have to wrap up in a couple of minutes. We were going to talk about banking union, but I wondered if there's one sentence that each of you could give me that that would help us to talk about what needs to be done to make the banking union work more efficiently or to get it sorted out. Is there? I mean, this probably may be a priority that you think needs to be done to make EMU work.
Maybe 20 seconds.
Yes, go for it. Yes.
For us, really, we should still have in mind this full mutualization on the European deposit insurance, the third pillar. And we know it's very difficult and it's very discussed here in Brussels. So at least start with the liquidity phase, put things together, and put a time plan for achieving the rest and start the whole movement.
I fully agree. I think probably the single most important thing that we need to do is to agree on these deposit insurance. Now, the good news is that...
So agree on the what? I missed what you said.
On the common deposit insurance for the euro area. The good news is that there is agreement that in the steady state, there should be a fully mutualized deposit insurance scheme. The bad news is that there is no agreement how to get there. So there's a lot of discussion about what are the preconditions to get there. Some link these to regulatory treatment of sovereign exposures by banks. Of course, this is an interesting idea, but if it's done in isolation, it can have significant financial stability issues. So it cannot be done in isolation. But I would agree with Boris, agreeing on the deposit insurance scheme and starting actual discussions on this is the most important thing.
Danny?
I would say I think the capital union is probably more important than the banking union, particularly for SMEs. And one of the features, I suppose, nearly 20 years into the euro, you still see differential between SME lending in different member states. And even at the element of the household, you see mortgage rates quite different as well for the same currency.
Right.
So I think that capital will be as more significant than the banking union. Well, both, but.
Klaus?
Maybe in addition to those points,
Yes.
I think we would work towards integrating the banking market again and stop ring fencing of liquidity and move to a system where supervisors and regulators feel fine with having a pan-European banking and capital market again. I think we have been there and it got hurt in the crisis.
Unfortunately, we're going to have to stop it there. And I know there was plenty more that we could talk about, and I'm sorry we haven't got more time for your questions. We have to all jointly be back into the main hall when the next session starts very promptly in about 2 minutes. So you have a quick skip up the stairs. But thank you very much for being here. Thank you to the panel. Okay.
José, is the group Euro framed?